Okay then guys, very good morning and welcome to the most important day of the trading week. So Janet Yellen's Jackson Hole Symposium coming up at 3 o'clock this afternoon. With that in mind, what I would do is treat this morning very much any of you who've traded previously on usually the first Friday of each month ahead of non-farm payrolls. Likelihood is it's going to be exceptionally quiet, barring anything unexpected. If you think about it, no real firm or fund is going to want to be entering the market with any type of size ahead of potentially a big degree of uncertainty. First of all though, for those, if you can, please jump on the Amplify Twitter account. I have just tweeted off of that to see what the sentiment is like for this morning. Only a couple of votes in because I only did it a few minutes ago, but please jump on Twitter and vote after the briefing. Be much appreciated. Good to sort of test the water of day to day. You do sort of see a little bit of swings, and these polls, although extremely small sample sizes, do give a quite interesting insight. You can see where my tick lies. We're going to go into Janet Yellen and what to expect from today, but certainly I do think she's going to stick to the status quo, so to speak, so more on the hawkish side. It looks like I am in the slight minority though, most looking for a more neutral stance. So please do vote when you can. We'll go over that a bit later on. Looking at the charts though this morning, as I've really kind of said, we've got oil top left, DAX, and S&P at the bottom. S&P very much just sidelined, let's say, until probably later on this afternoon. The DAX seeing a little bit of its usual volatility around the open of the cash equity market. Again, speaking to a couple of the live guys this morning who've entered a couple of trades on the DAX, on the CFD. If you are doing that, then I'd say just be a little bit probably more proactive than normal. Likelihood is that it's going to be quite choppy given people's sort of lack of commitment to really long-term hold to any trade. The S&P, the way it's looking this afternoon, or at least overnight, very much just encapsulates, I think, what Jim Reed of Deutsche Bank was saying. If you read your morning research, I think it's 33 odd sessions or so we've had a less than 1% movement in some of the US indices. So very quiet August trading conditions. Consolidation to a longer degree, obviously, if when you look at the S&P from that phenomenal rally that we had post-Brexit, and then where we've been really since the Bank of England's over delivery. Since that point, very subdued trading conditions, and also as the market waits for some of the bigger events to come, i.e. Yellen today, and payrolls of course next Friday. Before we just get our teeth into what to look out for from the Jackson Hole Symposium and Yellen's speech, just looking at WTI crude here on top left, we're basically flat at the moment. Not really too much movement in the dollar. It's marginally weaker, hence both major pairs in euro, dollar and cable are trading a touch higher this morning. The Dixie's trading down around 0.12%. But oil pretty unfazed, so flatlining at the moment. You've got the high print just before the NYMEX pit close at 47.46, so 10 cents above the current price at the moment. Some interesting comments though from late yesterday, if you haven't heard them, out of the Saudi energy minister. It's being touted as one of the reasons why we did drift here slightly lower overnight in the Asia session, although we have seen a bit of a bounce. But the Saudi energy minister tempered expectations of strong market intervention by producers at the informal meeting at the end of September. And the exact comments from Khalid El-Fali was that we do not believe any significant intervention in the market is necessary other than to allow the forces of supply and demand to work for us, adding that the market is moving in the right direction already. So if that isn't a clear enough signal from the biggest hitter within OPEC, so there's not going to be any type of action, any type of production freeze, then I don't know what is. As I've been saying before, the fact that prices are up at these more elevated levels in recent weeks, obviously more closer to $50 than below 40, then it's kind of the verbal comments out of OPEC nations, non-OPEC nations have kind of done their job. The other thing as well is, obviously, beginning of the week was based around Iran source comments, talking about they will be also attending that meeting. Iran have said today that they would cooperate with other producers to stabilise oil markets, but added that it expected others to respect its individual rights. Now, reading between the lines, essentially what that means is that now that they've had their sanctions dropped a few months ago, likelihood is they want to continue ramping up their own production. So highly unlikely, I feel, that they will agree to any type of freeze when they've been impeded by sanctions for such a long time. They want to ramp up as quickly and as high as possible their production in order to make more money, essentially. So an agreement, I think, at that meeting is looking less and less assured, but at this point, oil pretty unfazed, seems to be caught in the new kind of value of where the market sees it. At this point, just shy of 50. Okay, moving on then to Jackson Hole. Let me just bring into screen an FT article. I did send this out to you guys this morning, so please do take a read. This lady's going to take centre stage this afternoon, and how firstly this gets delivered, we'll do a more thorough run through closer toward the time. Actually, Piers and I are going to do a Facebook live session where we're going to do a bit of a Q&A type. I'm going to ask him a few questions about his thoughts, how he's going to look to trade it, so on and so forth. We'll do that around 10 o'clock this morning, so if you jump on Facebook, you can tune in live for that. But in terms of how this will come out, it's a prepared text speech. So what that means is that the news agencies such as Bloomberg, Reuters, for example, they will already have Janet Yellen's speech probably half an hour before it is embargoed to be released at 3 p.m, which is when she also starts speaking. So from a trading point of view, when she actually appears and starts speaking, for us, we don't care, because all of the comments of note or of interest, i.e. let's say the 10 most important, which the journalists at Bloomberg have identified, they all get dropped on the news terminal immediately at the stroke of 3 p.m. this afternoon. Now at that point, essentially what happens is 10 comments drop down Bloomberg. There's usually 2 that they identify as the 2 main kind of stickies, they call them. That's because they remain red and highlighted at the top of the screen. And that will ultimately be what traders and squawkers will look at, talk about, and what traders will action first and foremost. They should then be, in essence, be the 2 most important comments from her speech. One word of warning though, you are relying on journalists at Bloomberg to identify those comments. They do often choose different ones between different news wires, which can add to the initial volatility. But certainly if the squawkers are doing their job right, you should hear those first, then all the other comments, and they'll be identifying the important ones. Obviously, we're looking for really concrete signs of any commitment to September, or the complete reverse. Does she break the trend of recent hawkish comments from other Fed officials and go for something a little bit more dovish to take September off the table? So a quick look at the state of play. A couple of charts here from the FT, and the thing we've been talking about for a while is this market calm at the moment. We've talked about this price action, less than 1% kind of range that the S&P's been trading for such a long period of time, kind of well over a month now. The trading volume of the S&P as well, you can see here, is month over month. You've got here the flashes of volume, and then the overall average, we're dipping at the more recently. So the market has been, I feel, a little bit complacent as towards the probability of actually the Fed hiking in September. I think that given the Italian banking crisis of just, if you remember, it was only 3-4 weeks ago, we were all panicking about that. Bank stocks were down. Big names like Deutsche Bank, we're talking nearly double-digit percentages. Obviously, things have stabilized a lot since that point. However, I feel though the US economy domestically has held up fairly well. Obviously, you've had the 2 really big payroll numbers, plus 250 type areas, forecast busting on the jobs front, Housing data we've been seeing more recently as well, very strong. Jobless claims have been tracking at historically quite low levels. A couple of concerns on inflation, but it seemingly appears to be now on the right track, at least moving higher. But growth subdued, but growth nonetheless. So there's a couple of things to balance here when talking about the probability of a hike occurring. The one thing here that's quite interesting is this is a chart of the September and December meetings. So the slightly darker shade here is the September meeting probability of a 25 basis point rate increase based on federal funds rate futures. You can see here this big almost cliff dive from 40, 42 type level all the way down to actually zero chance of a SEP hike. That was of course post-Brexit. But one of the things was the reason why the Fed didn't hike in the summer predominantly was because of Chinese uncertainty and the threat of Brexit fallout. Now, China's really not been spoken about for quite some time. Actually, China's taken not just a backseat, it's pretty much off the agenda, at least from a global macro point of view. That's not to say it might re-emerge, but certainly it's not a front-running theme at present. Then Brexit, actually the fallout from that has been relatively contained. Cable's back up at above 132. The Bank of England have promised a lot of further accommodation in policy, and at the moment that seems to have done the trick in order to stabilise the economy. UK data points are still showing, from a manufacturing service point of view, a struggling economy, but certainly the worst case scenario has been averted at this point. And also as well, there's been a lack of contagion into Europe, at least so far. So these are all positive signs in order for the Fed to be more hawkish. And certainly from Dudley, I think it was about 2 weeks ago, who really surprised the market with uber hawkish comments. You've had Kaplan, Mester, you name them, they've been out in force telling you what we already know. The dot plot projections are for 2 rate hikes this year. Why are we disbelieving what the Fed are telling us? The projections say rates most likely will rise in September and December. 2 rate hikes left for 2016. Fed officials have been saying we're going to hike rates. The only problem is the market's been less enthused to believe what they've been saying, but I would say in the last 2 weeks we have risen considerably. From around 15% probability, that has almost doubled towards 30% now. Now, whether this September becomes a viable option really is down to 2 key events. One is this afternoon, Janet Yellen, how will she be interpreted? And then secondly is non-farm payrolls, which we get on the 2nd of September, so next Friday. If that figure is quite key, because at the moment, strong non-farm payrolls is almost a linchpin of being a Fed hawk. If that figure comes in plus 250 again, then it's going to be, from their point of view, game on for a September hike. But should we get, let's say, a figure of 100 or below, then probably you're going to see September again wiped off the table, at least from a market perspective. And let's not forget, we were at 11,000 in US jobs growth only, I think it was, 3 or 4 months ago. So it's not out of the realm of reality. Looking at some of these other charts, the VIX index, this is the volatility measure. Obviously, again, this is why I'm talking about the market, for me, seems a little bit susceptible to getting a bit of a nasty surprise here, because from a volatility point of view, the market is highly unprotected for bouts of shocks, if you like. And so, this has a dual effect. The Fed need to do a better job of communicating the market their seriousness if they are going to do a rate hike in September, and hence this is the reason then that Janet Yellen's speech is so important this afternoon. From an equity perspective, again, this is the daily change in the S&P, so this really just showcases what I was talking about the very tight range we've been in in August, and certainly July, August, really the summer period. One thing is the Lipper report. Those of you who don't know that, that's basically like a measurement of fund flows that you get. And what it has shown more recently is that Wall Street investors have basically shifted to the sidelines. Now that equity markets, by many measures, you could argue is highly overvalued, we've kind of consolidated just shy of this 2200 level at these all-time highs, and a lot of investors have actually pulled their money out of the market from a more proactive investment fund point of view, because they do not want to get caught by a hawkish surprise. If the Fed do hike rates in September and the market is ill prepared for that, as some of these charts might suggest, then equities are quite ripe for a bit of a correction of sorts. If that happens, obviously these equity type funds are not going to be invested in the stock market at that point. So a couple of things to contemplate. Gold, for one, has been a fairly good barometer. It's seen some pretty nice moves actually on the back of some of these hawkish comments. This could be one of the better assets to actually look at when Yellen speaks later on, as a true gauge towards the market's feelings towards the probability of September. In terms of my view on what I think Yellen will come across as today, I think it's pretty much wrapped up by what Deutsche Bank is saying here. While we do not expect Yellen to explicitly pre-commit to raising interest rates at the meeting in September, she will no doubt want to retain the optionality of hiking next month if economic and financial conditions persist or permit. I do strongly believe that her job today is just to keep the option open without rocking the boat too much. Therefore, status quo. She just pretty much repeats what she said before. If you remember, the previous FOMC statement was fairly upbeat. There's no reason to deviate from that. The economy's held up in the same kind of regard as it had when she last spoke. Of course, though, she will not pre-commit. Now, as you know, for those who've been in the market long enough, these wily old foxes that are the central bank governors are far too skillful, far too political to really pre-commit to anything, as to keep open the option, what if China decided to devalue their currency strongly again? What if an Italian bank went bankrupt? You know, these are unforeseeable hurdles, and so you would not want to pre-commit to something when you do not know what the next 4 weeks until the next meeting holds. So I reckon she's going to not explicitly pre-commit to anything, but keep the option open, i.e. status quo. Anticipate Yellen's speech will outline the rationale for taking another step in policy normalization process, but will also discuss the broader ramifications of a potentially lower equilibrium real rate. So overall, fairly balanced, but sticking with the way the economy is performing, moderately hawkish, I would say. We shall see. Time will tell. 3 o'clock is the scheduled date of release or time of release. Quick look at the rest of the calendar for today. If you are going to trade around any of the data points, you want to be quick in and out, because the market is not going to likely show much commitment to really push in either direction ahead of the main event. With that being said, you've got UK second reading of Q2 GDP. You actually get the same later on this afternoon from the US. And if you remember, when we got the first reading of growth for Q2 in the US, it was a bit of a disaster. 1.2% against expectations of 2.6. Will that be revised higher? If that is the case, then obviously that gives the Fed a little bit more room to be more comfortable with sounding hawkish into the September meeting. You've also got inflation readings, PCE, then you've got US trade balance, and also Michigan. Michigan comes out though at the same time as Yellen. Forget about Michigan, no one cares. It's all about Yellen. Okay guys, so good luck this afternoon. Keep it tight this morning. You know, you want to have ample bullets available should Yellen come out with something surprising. If the market moves a lot, you want to have the scope to be able to trade it. So don't get tied up in anything too much this morning. We'll have more full, thorough previews for Yellen again closer towards the time. But I'm going to leave it at that. Enjoy your day. Please do jump on Twitter, vote on our view or our poll as to how you think today will be perceived. As I've been speaking, and I know I've been sounding a little bit hawkish myself, quite interesting to see I've been infiltrating your minds and you've started to lift the hawkish side a little bit. Don't let me, it's just my view. Have your own. Okay, enjoy your training session and good luck today.